His name was Jacques Rueff. He was 65 years old. He worked as an economic advisor in the offices of the Banque de France at the Palais Royal in Paris. In the winter of 1961, he had a leather briefcase, a lifelong conviction about money, and a warning that no one in power wanted to hear. The warning was this: the international monetary system was a confidence trick, not a conspiracy, a structural impossibility, and it was going to collapse. Rueff had spent 4 decades inside the machinery of European monetary policy. He had worked on the franc's devaluation in 1926. He had watched Britain's gold standard fail in 1931. He had advised Charles de Gaulle through the fiscal reconstruction of the Fifth Republic in 1958. And since the end of World War II, he had watched the United States run perpetual balance of payments deficits, flooding the world with dollars that other countries were legally entitled to convert into physical gold at $35 per ounce. The math did not close. He knew it. He had published it. He called it the monetary sin of the West. Here is what he understood that almost everyone else in the room missed. The Bretton Woods system, agreed upon by 44 nations in July 1944, had built a hidden instability into the foundations of the entire post-war economic order. Every dollar held as a reserve by a foreign central bank was simultaneously a claim on the American gold supply. The more dollars circulated internationally, the more the gap widened between what the United States owed in gold and what it actually held. By 1961, that gap had become structural. Non-American central banks held $14 billion in dollar reserves. The United States held $17 in gold. Manageable. But the direction of travel was clear and accelerating. Every week the U.S. ran a deficit. More dollars went abroad. Every dollar that went abroad was a potential gold redemption. And nobody in Washington wanted to tighten policy sharply enough to stop the outflow, because tightening policy meant slowing the domestic economy, which meant political consequences, and no president since Eisenhower had wanted to carry that. So they built something else. In November 1961, the central banks of 8 nations, the United States, the United Kingdom, West Germany, France, Italy, Belgium, the Netherlands, and Switzerland, secretly agreed to pool their gold reserves and deploy them into the London gold market whenever private demand threatened to push the price above $35.20 per ounce. They called it the London Gold Pool. The Bank of England would operate it on their behalf each morning after the daily gold fix, the 11 a.m. price published from a room in the City of London that had functioned since 1919 as the world's most visible signal of confidence in the dollar. The pool started with $270 million in gold, the United States contributing half. 7 nations, 1 agreement, 1 number to defend. It was the most ambitious act of coordinated central bank intervention in history. Jacques Rueff read the terms of the arrangement and understood immediately what it was. Not a solution, a delay, a mechanism for burning through the gold reserves of 8 nations slowly, rather than all at once. It would buy time. It would not change the underlying arithmetic. He said so. Nobody wanted to hear it. You are in London. It is the morning of November 8, 1961. The gold fix has just been announced. $35.08 per ounce. The number is holding. The newspapers report nothing unusual. The financial world has no idea that 8 central banks have just signed a secret agreement to defend this number with physical gold. The system looks permanent. The system feels permanent. You would have no reason to doubt it. That is always how it looks from inside a system designed to suppress visible information. Rueff is wrong about the timing. He is correct about the direction. He goes back to his briefcase and continues writing. For the first 3 years, the pool worked exactly as designed. Between 1962 and 1965, it accumulated a net surplus of $1, 43 billion, meaning private demand for gold was manageable, and the pool was actually buying gold back on price weaknesses. The system generated confidence. Central bank governors at Basel complemented each other. The operation remained so secret that when a Swiss newspaper, Le Courrier de Genève, first revealed its existence in March 1962, the denial from official channels was firm and complete. The pool did not exist. The aid nations were not coordinating. The price was holding because markets were confident. None of that was true. Here is what blows people's minds about those early years of apparent stability. The Bretton Woods system was generating the very conditions that would eventually destroy it. Because the dollar was the reserve currency, every country that ran a trade surplus with the United States accumulated dollars. Dollars they did not spend returned to the U.S. financial system as deposits, funding further American consumption, further deficits, further dollar outflows. The system was a machine for producing the imbalances that would eventually break it. And the London gold pool was the pressure valve. As long as it held, the machine could keep running. The moment the valve failed, the pressure had nowhere to go. The first serious crack appeared in the spring of 1965. Charles de Gaulle held a press conference at the Palais de l'Élysée on February 4th of that year. He had been briefed thoroughly by Ruff. He stood before the assembled journalists of the International Press Corps and stated, in terms that left no diplomatic ambiguity, that the international monetary system was structurally rigged in America's favor. The United States, he said, was being indebted to foreign countries free of charge, paying what it owed in dollars that it could issue at will, while other nations had to produce real goods and services to acquire those same dollars. His finance minister, Valéry Giscard d'Estaing, had a phrase for it, the exorbitant privilege. De Gaulle then announced that France would begin converting its dollar reserves into physical gold at the official $35 price and repatriating that gold to Paris. France was a member of the London gold pool. France was now explicitly draining the system it had agreed to defend. He was not breaking any rule. He was using the rule, the legal right of convertibility, to demonstrate that the rule was unsustainable. He sent the French Navy to New York to collect the first shipment. $150 million in gold, physical bars loaded onto French naval vessels transported across the Atlantic. He is wrong. De Gaulle believes France can break from the dollar system and construct an alternative built on gold. He has not accounted for what happens to French exports, French banking, or French political capital in Washington when America decides to retaliate. He will pay for this calculation in ways he did not anticipate. But on the central question that the London gold pool is burning through finite reserves to defend an unsustainable price, he is entirely correct. By 1965, the pool's cumulative surplus was over. From late 1965 through March 1968, it would hemorrhage $3.69 billion in gold. The direction had reversed. The tap was now running the other way. Between 1958 and 1968, the United States lost over 8,000 metric tons of gold from its reserves, from 20,000 tons at the end of the 1950s to around 12,000 tons by the end of 1968. The U.S. was losing, on average, over 800 tons per year, every year for a decade. The money supply kept expanding to fund the Vietnam War. The balance of payments deficit kept growing. The gold kept leaving. By 1966, non-American central banks held $14 billion in dollar reserves, while the United States had only $13. $2 billion in gold, of which just $2 billion was legally available to cover foreign claims. The math had flipped. If every nation entitled to gold had walked up to the window simultaneously, there was not enough gold to pay them. Not even close. The London gold pool limit, the maximum the Bank of England could spend defending the $35 price in a given period, had started at $270 million. By September 1966, it had been raised to $320 million. By May 1967, to $370 million. By June 1967, to $420 million. By July 1967, to $170 million. By October 1967, to $520 million. The numbers were accelerating. Each increase was a central bank governor walking into a room, looking at the reserves chart and deciding to keep playing rather than fold. Then on June 21st, 1967, France officially withdrew from the London gold pool. This was not a surprise. France had been effectively defecting for 2 years, converting dollars into gold while nominally remaining a pool member. Now de Gaulle made it formal. He moved large quantities of gold from New York to Paris. The remaining 7 members, without France's quota, were now covering a larger share of each intervention out of a smaller combined reserve. The pool had been designed as a coalition of equals defending a shared interest. France's departure revealed that the shared interest was an illusion. Each member was calculating its own exposure. You were in the dealing room of the Bank of England. It is November 1967. The British pound sterling has been under speculative attack for months. The Treasury knows what is coming. The traders know what is coming. On November 18, 1967, the United Kingdom devalues the pound by 3% from $2.80 to $2.40. It is the largest sterling devaluation since the Great Depression. The world's secondary reserve currency has just lost 3% of its value overnight. If sterling can be devalued, can the dollar? That is the question every holder of dollar reserves is asking simultaneously. The answer they arrive at drives them to the same action: convert dollars into gold before the window closes. The London gold pool bleeds. The Bank of England's monthly net sales to the market, which had been running at manageable levels through most of 1967, spiked catastrophically in the fourth quarter. In November 1967 alone, the pool limit was more than doubled, from $520 million to $122.7 billion. By February 1968, it was raised again to $2.57 billion, nearly 10 times its original ceiling. Every increase was a decision to fight longer. Every increase consumed more gold. Quick pause. If you are beginning to see the mechanism, not the event, the mechanism, hit subscribe. This is the Money Architect. I do not tell you what to buy. I show you how the system was built, who designed the trap, and who walked away when it closed. It is free, unlike the lesson Jacques Rueff paid for 3 decades trying to teach. In January 1968, President Lyndon Johnson delivered his State of the Union address. The Vietnam War was escalating. U.S. casualties were mounting. The Tet Offensive began on January 30th. The world watched American military credibility fracture in real time. And as it did, private demand for gold, the ultimate hedge against governmental failure, began to surge in the London market. The daily gold fix, that morning ritual at 11 a.m. in the City of London, was the barometer. Through the 1950s and most of the 1960s, the gold price had rarely moved more than 20 cents in a single session. A 2-cent move made headlines. Now it was straining against the $35.20 ceiling every morning. The Bank of England dealers were selling gold before the fix concluded. Not theory, not speculation, historical fact. The system was dying in real time, one morning, fix at a time, and everyone in the room knew it. Friday, March 8, 1968. The London gold market sells 100 tons of gold in a single day. A normal day runs 5 tons. That is a 20-fold acceleration in a single session. The same Sunday evening, the governors of the remaining pool members met at the Bank for International Settlements in Basel and released a statement affirming their determination to defend $35. Federal Reserve Chairman William McChesney Martin announced that the United States would defend the price, and he used the phrase that every markets professional in the world would remember, down to the last ingot. He is wrong. By Wednesday, March 13th, daily sales had reached 175 tons, 30 times normal. On Thursday, March 14th, gold purchases spiked to $400 million in a single day. Emergency airlifts were underway, transport aircraft flying gold bars from U.S. vaults to Heathrow, racing to replenish the Bank of England's inventory before the next morning's fix. The flights could not keep up with the redemptions. That Thursday evening, March 14, 1968, the United States government called the British government and requested that Queen Elizabeth II petition the House of Commons to declare March 15th a bank holiday. The request was granted. The most important gold market in the world, the London gold market, was closed, not by a collapse of confidence, not by a bank run, not by a war. It was closed by a phone call because the 8 nations defending the $35 price had run out of time. A weekend conference in Washington followed, March 16th and 17th, 1968. The representatives of 7 central banks, France was no longer in the room, met to decide what to do with the system they could no longer hold together. On Monday, March 18th, the United States Congress passed a law repealing the requirement that the U.S. Treasury maintain a gold reserve to back the dollar. The gold reserve requirement, which had anchored American monetary credibility since the Depression era, was removed in a Monday afternoon vote. The London gold market stayed closed for 2 weeks. When it reopened on April 1st, 1968, everything had changed. The world now had a 2-tier gold system. Central banks could continue to exchange gold among themselves at $35 per ounce, but the private market was free to trade at whatever price buyers and sellers agreed. That price on the first day of free trading was already above $35. The London gold pool had not been wound down. It had been abandoned. Same pattern, same stages, same outcome. What did the people who held physical gold through this period end up with? The answer is not complicated. From $35 per ounce in March 1968, the gold price reached $44 per ounce by 1970, $100 by 1974, and $850 per ounce in January 1980, a 2,300% increase in 12 years. The people who had trusted the system, who had held dollar reserves on the explicit guarantee that those dollars could be exchanged for gold at $35, received instead dollars that were then devalued and devalued again, and ultimately cut loose from gold entirely on August 15, 1971, when Richard Nixon appeared on national television to announce the temporary suspension of gold convertibility. That temporary suspension is still in effect as of 2026, 55 years later. Now, who in the system profited from the collapse that the pool had been built to prevent? The answer begins with the 8 central banks that operated the pool. Between 1965 and March 1968, those banks deployed $369 billion in gold, physical bars vaulted in London and New York, to defend a price that the market was telling them every morning was wrong. They burned the gold of their taxpayers to maintain a fiction that served primarily the U.S. government's ability to run deficits without fiscal discipline. When the system collapsed anyway, those nations absorbed the losses. Germany had contributed more than any other European member, in part because it had agreed to hold dollars rather than gold in exchange for continued American troop presence after the Berlin Wall was erected in August 1961. The political and financial arrangement was explicit. Germany sacrificed gold claims in exchange for military security. The calculus was rational, the losses were real. The people who profited were the ones who had converted dollar claims into physical gold before March 1968. France, despite its political costs, repatriated its gold. By the time Nixon closed the window in 1971, France held physical metal. The dollar holders held paper that would lose a third of its value against European currencies over the course of the 1970s. Here is what history shows about the specific mechanism that destroyed the London gold pool. It was not, as the official account suggested, a failure of cooperation. The Bank for International Settlements Research, published in the National Bureau of Economic Research in 2017, drawing on declassified archives from the Bank of England, the Banque de France, and the Federal Reserve of New York, shows clearly the pool's members were in fact cooperating as agreed. The problem was that cooperation worked exactly as designed, and the design was structurally impossible. Every time the pool successfully sold gold to suppress the price, it created the appearance of stability, which encouraged more dollar accumulation by other central banks, which expanded the future liability. The more effective the intervention, the deeper the eventual problem. This is not a unique mechanism. The Bank of England attempted almost exactly the same operation between 1925 and 1931. After World War I, Britain had inflated its money supply significantly, but chose to restore the pound to its pre-war gold parity of 4 bonds, 86 rather than devalue. To maintain that rate, the Bank of England coordinated with the US Federal Reserve to suppress gold flows and keep credit conditions artificially loose. The economist John Maynard Keynes publicly argued that the rate was wrong, that the pound was overvalued by approximately 10%, and that defending it would require painful deflation. He was dismissed. The Bank of England defended the rate for 6 years. On September 21, 1931, Britain was forced off the gold standard in a crisis that spread immediately to 25 other countries. 6 years of reserve depletion to defend an unsustainable rate, followed by a collapse that accomplished in a weekend what the market had been signaling for years. The same mechanism appeared in 1992, when the European exchange rate mechanism attempted to hold currency parities that the market no longer accepted. The mechanism was a coordinated commitment by European central banks to keep their currencies within agreed bands against the Deutsche Mark. George Soros, the currency speculator, calculated that the British pound and Italian lira were overvalued within the system, and that the political cost of defending those rates exceeded the political cost of devaluing. He bought options on both currencies. On September 16, 1992, Black Wednesday, the Bank of England spent $27 billion in a single day defending the pound, raising interest rates twice in the same afternoon before surrendering. Britain withdrew from the ERM. The pound devalued. Soros made $1 billion in a day. The mechanism was identical. A coordinated defense of an unsustainable price, financed by burning through finite reserves, abandoned when the reserves ran out. The pattern is mathematical. The outcome is structural. Now the modern parallel. As of 2025, the United States holds roughly 8,133 metric tons of gold, essentially unchanged since Nixon closed the gold window in 1971. In that same period, the U.S. money supply, as measured by M2, has expanded from approximately $118 million in 1971 to over $21 trillion in 2025. The ratio of dollars to official gold reserves has expanded by a factor of more than 30. China has increased its official gold reserves from under 400 tons in 2009 to over 2,300 tons in 2009, according to People's Bank of China disclosures, the largest multi-year accumulation of gold by any central bank in the post-war era. The central banks of Russia, Turkey, India, and Poland have followed the same direction. Central bank gold purchases in 2022 reached 1,136 metric tons, the highest annual total since records began in 1950. In 2023, 1,313 tons. In 2024, over 1,000 tons for the third consecutive year. Not theory, not speculation. Historical fact. The countries accumulating gold are the countries that hold the most dollar reserves and are therefore the most exposed to the risk that the dollar undergoes a forced repricing. They are not announcing that the dollar system is ending. They are moving quietly. The way the Venetian nobles moved their capital to mainland farms in the 1490s while still attending ceremonies in the lagoon. Jacques Rueff spent 20 years warning that the Bretton Woods system would collapse under the weight of its internal contradictions. He was right. He watched the London gold pool formed in 1961 to suppress the signal. He watched it burn through $69 billion in gold from 1965 to 1968. He watched it abandoned on a Thursday night by a telephone call between two governments. He published his account of the mechanism in a 1971 book called The Monetary Sin of the West. He died in 1978, 7 years after Nixon closed the window. having watched his entire analysis confirmed in precise sequence. What he understood, and what the 8 central banks in the London gold pool understood too late, is that you cannot maintain a system by suppressing the price signal that tells you the system is failing. You can only delay the adjustment, and the longer the delay, the more violent the eventual adjustment must be. The gold price went from $35 in 1968 to $850 in 1980. The US dollar lost 33% of its value against European currencies in the decade following Nixon's announcement. The people holding dollar paper received the adjustment. The people holding physical metal received something else. The mechanism is not gold. The mechanism is the gap between what a system promises and what it can deliver, and the political decision to maintain the appearance of solvency rather than address the underlying insolvency. Every coordinated intervention in financial history has followed the same architecture. A coalition of institutions defending a price burning through finite resources, raising the limit when the original limit proves insufficient, and finally abandoning the defense when the resources are exhausted, leaving the cost to whoever was last to convert. The London gold pool burned 3,000 tons of gold across 7 years to defend a price that the market had been telling them every morning was wrong. When it ended, the people who held gold held metal. The people who held dollars held a promise from a government that had just proven it could not keep its promise. Now go check what you are holding before the next phone call is made.